Hello. Happy Tuesday.
Hi, everybody. I was looking at ourselves in the camera while we were joining today, and I was like, "Man, we are a pattern combination
Oh,
today."
I think I'm ready for vacation.
I don't know. We so don't mind. We obviously didn't coordinate. This is a lot for the screen today, but that's okay. I hope you are having an incredible Tuesday. If you're in Ottawa, it seems like it's a gorgeous day out. I went out very briefly this morning, so hopefully you're enjoying the nice weather. Um, we have a really fun topic today. I think it's fun. It's the reason that we were so attracted to the buy and hold space. As many of you know, we weren't always focused on buy and hold. We did a little bit of time in the flipping space, but it's because of the topic today that we always come back to the buy and hold multifamily. So that's why I think it's exciting.
Yeah, we're talking a little bit more about true wealth generation today and how you can build that wealth
Mm-hmm.
versus just getting cash flow, quick income.
Yeah.
Yeah.
And I think the cool thing about this, and we're kind of like,
Wait, before we before
okay,
we before we get into it.
okay.
If you're new here, I'm Jeff and this is my wife and business partner Dakota.
Hi.
Um, We do these every week. This is our weekly power lunch. We do it over lunch. You can enjoy eating your food while listening to us banter over various topics.
Yep.
We always have a different topic every week. If there's something specific that you want to hear us talk about, let us know. Reach out to us. Write it down in the comments. We want this to be as interactive as possible as well. That's why we do them live. So if you're here, say hi. If you have any comments about what we're talking about, if you have your own input, definitely let us know, and we're going to be reading the comments throughout this as well. So if you have questions, we'll be answering them.
Yeah.
And if you're coming in from YouTube, we're very active on YouTube as well. So if you comment on it, we'll respond.
Mm-hmm.
And if you have any feedback.
Yeah. If you ever, for some reason, have to miss this while it's happening live, they are all posted on our YouTube channel. So if you want to go back and see what some of our previous topics have been, go to our YouTube channel. You can search Opinacon Investments and you'll find it there. They're all posted. So we obviously love when you join in live because we love the interaction, but if you can't make it or you miss one, it's going to be on YouTube. So don't worry about that. Yeah.
Hey, Jasmine, thanks for tuning in.
So I think that's, am I allowed to continue now?
Yes. Now that I had to share with everybody what we're doing and why we're doing it.
Okay, fair enough.
Not everybody's here every week, so
I know. So we haven't talked about what we're talking about yet, which I like kind of dangling it for a little, and I'm going to do that for a little bit longer. So the one thing that I like about this topic today is that we when you talk to a lot of very wealthy people, and I know this is one of the first things when I first met someone who was quite wealthy, they told me that what I should look to do is get multiple sources of income because that is going to help if one of the sources isn't working as well, you can rely on the other ones that you have, so you diversify that way, and that's how you're going to secure your wealth, and is through that diversity.
Mm-hmm.
So the cool thing about this is that in real estate you can do that in one property. So today we're going to talk about the profit centers within real estate. Obviously, this is directly related to buy and hold real estate because if you're doing something that is a quick turnover, you're flipping a property, you're wholesaling a property, obviously you're not going to be tapping into all of these profit centers. You're going to really just be tapping into the active income side of it. So, this is related mostly to buy and hold, but I love it. I love the fact that you can buy a property and do exactly what some of the wealthiest people say within one strategy.
Mm-hmm.
You're not relying on one source of income. You're relying on multiple sources.
Yep.
And I think that's really cool. There are obviously some that are going to provide more of a return, some that are going to be more, I never want to say guaranteed. I don't like that word in any type of investing, but
predictable,
more predictable, more guaranteed, whatever you want to call that. There are some that are more predictable, some that are less predictable. But that's why you have multiple of them, because they can come together and kind of secure your return in that way, which is really cool. So I think maybe we'll step it back and say, like, talk about, I know a lot of you have heard kind of the beginning of our journey before, but talk a little bit about why this was so attractive to us when we first started.
Yeah, I think you covered a good chunk of it, but really we want to build wealth. We want to build for our future, right? So it all boils down to all the benefits of buy and hold. Ultimately, that was the goal, is to buy assets and hold them and own them and have that ownership and building that equity, because equity is really where wealth is created. Now, we had transitioned strategies in the beginning because we had taken a look at our long-term goals and broken them down into smaller bite-sized goals, I guess. Steps.
Maybe.
Yeah, steps. I like that. In order to get to our long-term goals. Now, one of our short-term steps was actually quitting our 9-to-5 jobs and being able to focus on real estate full-time. In order to do that, we needed faster income. We actually looked at how many doors would we need in order to replace our income. And it was a lot. I don't know exactly how many, but it seemed unreachable. Yeah. It seemed like I don't know if you guys have ever seen the ladder, the taking big steps versus taking small steps. You've got this one guy trying to reach the first rung of the ladder, and he's too short to do it, or the rung is too high because his goal is just out of reach, versus the guy that has a bunch of little steps to get up, and he's progressing up that ladder.
Yeah, and I think really from the beginning we knew that we wanted to do multifamily because we knew that there were these profit centers, but we did have to switch gears for a little while and do some of the flipping so we could create some income to leave our jobs. But this is why we've now transitioned back into the multifamily focus. And this is also why the way that we work with our passive partners is more through partnership and less through private lending. We did a lot of private lending before, and now we're focused more on equity partnerships because to us, that's where you build wealth. And a lot of that comes from the fact that your partners are sharing these profit centers with you, right? And I think that is that's really important when our goal is to help people build wealth. It's that equity piece that's going to get them there, right? So why don't we hop into what those profit centers are? I know there's we always talk about 4 main profit centers. There are some other profit centers that people talk about in real estate. We tend to talk about 4 of them because they're kind of the most obvious, most fruitful. There's
4, there's 6, there's 7. It depends who you're talking to and
how the source you're looking at
and how they're doing it. Yeah. I think the number 1. Do you want to just go through them? Kind of one. We'll talk about it and go to the next one.
Yeah. Let's do that.
So cash flow. Everybody knows cash flow. What is cash flow? Cash flow being everything that's left over after you've received your income and you've paid your expenses on the property. Anything left over is going to be cash flow. Why is that important?
I mean, the importance of cash flow and the importance of a building cash flowing is that it's not a liability. To me, that's really the importance of cash flow. Obviously it's nice having money in your pocket every month, but it's not typically going to be, especially in like your long-term rental multifamily, cash flow isn't often going to be, in our area anyway, in the Ottawa market, in the Ontario market, cash flow isn't typically the thing that's going to be really producing a lot of your return. There are some areas that are more cash flow heavy, less appreciation heavy. But in our area, cash flow isn't really the biggest return that you're going to get. But it's really important because if you aren't cash flowing, if you are taking money out of your pocket and putting it into that property, that can be viewed as a liability. Now, because it's taking money out of your pocket, it's not putting money into your pocket.
Yeah, and if you look at it from a business perspective, now you have a negative cash flowing business. So now you're putting money into that business every month rather than that business putting money, being able to sustain itself, number one, and number two, putting money into your pocket.
Yeah.
You always hear cash flow is king. Absolutely. I don't disagree that you should have positive cash flow, 100%. It's not necessarily your biggest return, as Dakota said. So I wouldn't look at only the cash flow as your returns. This is why we're talking today about multiple profit centers within real estate.
Yeah.
But cash flow is certainly important.
And I do want to mention that it really depends on your strategy. So for Jeff and I, we don't like negatively cash flowing properties. There are some people that's part of their strategy is to have some that are negatively cash flowing.
Because they anticipate that it's going to go up in value and they'll tap into that later.
Yeah, that's not the way that we operate. That's not something that we like to do. But again, remember that this is our experience. This is coming from our perspective, and there are different ways of investing in real estate. This is just how we view it.
This is our show.
No, but I always want to say, like, not
this is our show.
It is our show. But I always want to make sure that we are very clear that there's never like a right and a wrong necessarily. It all depends on what your situation is. And right now, cash flow is tough, right? It's very tough to make anything cash flow these days with
interest rates being as high as they are, with sellers coming out of a COVID-19 type of market, because everything was way, I'll say, inflated during COVID. The prices of properties were going for way more than they should have. The sale price, and that's affected sellers today because they're still coming off that high and they're not quite ready to let their building go for what it's actually worth versus what they could have received for it 2 years ago. Yeah.
So we know cash flow is really tough right now, and maybe cash flow is going to be skinnier on a property that maybe does work. But just remember that everything that we talk about, it's all a gray area. Strategies differ between people, and it all depends on what is best for you. So if maybe your property isn't cash flowing right now, but you can hold it until, if you're on a variable rate, maybe you can hold it until hopefully things get better. But again, that's really projecting and hoping that things will get better. But if you can handle it and you're okay with that, maybe that is the right situation for you. So just want to make sure that that's clear. But yeah, obviously everyone knows about cash flow. I think I
don't want to assume though. I want to lay it out so that people understand what it is, because we have various people listening to this and they're not all seasoned investors. We have some that are brand new coming into real estate. So I want to make sure that everybody's understanding in kind of what we're talking about and where we're coming from.
Yeah. So cash flow, that's your number one. That's the easiest one to understand. It's what's left over after you've paid everything for that month, including your mortgage.
And received all of your income.
Yeah. The other one that I think is I think people forget about this one, actually, which is really interesting. But it's the fact that you're paying down your mortgage, but you aren't paying it down. Your renters are paying it down.
Your tenants are paying down your mortgage. That's very, very powerful.
Yeah. And I think a lot of people forget that that's going to be part of your equity. So every single month when your renters pay you their rent, you're going to take that money and put it towards the mortgage, and that's going to be paying down that mortgage. And that's actually going to
assuming you don't have an interest-only mortgage.
Assuming you don't have an interest-only. So if it's like a mortgage that has an amortization,
then you're paying down principal.
Yeah. So in those situations, you're creating equity in the property with, again, money that is coming from the people that are renting from you. So I think a lot of people forget that one, that's actually a return for you.
You're just widening the equity gap.
Yeah.
Building the equity in the property.
Yeah.
Your tenants are actually building it again because they're paying down your mortgage for you.
Yeah.
Assuming you have a positively cash flowing property.
Yeah. And I would say that one is, as long as you're paying your mortgage, that's your most predictable return.
Yeah.
Is your mortgage pay down. It's not guaranteed, because if you stop paying your mortgage, I mean, you're going to have other problems, but you're also not going to be getting the mortgage pay down. So, that is what it is. But that really is your most predictable return is your mortgage pay down. Because if your tenants don't pay the rent for that month, your cash flow is going to change, right?
Especially if you're on a fixed mortgage.
Yes.
If you're on a fixed payment for that mortgage, then you know how much if it's going towards principal.
Yeah,
and
exactly.
You know how much is being paid down over the amortized period.
Yeah. And, you look at all these other profit centers, there's different variables that can change it month to month. So your cash flow, someone doesn't pay their rent, maybe an expense goes up that month that you weren't expecting, your cash flow is going to change. So it's pretty predictable, but there are factors that can change that. Mm-hmm. Your mortgage pay down is going to be your mortgage pay down every month as long as you pay your mortgage. So I think that's a really cool return that people tend to forget about. And again, cash flow is really the only one that you're going to be seeing in your pocket. The rest of these are creating equity in your property that you can now tap into at different times with different strategies. So one of them is mortgage pay down. The rest of these are all going to be like equity-based returns.
Since we're on the topic of mortgages, though, let's dive into the next one, being leverage. Love leverage. Using other people's money, using the bank's money, or as Dr. Cola puts it, and I really like this, it's still OPM, but instead of people, he says pots. So other pots of money.
Yes, I like that. I've never seen that before, but I thought that was really cool.
Yeah, and it doesn't take you off of that 3-letter acronym that we all love, OPM. Yeah.
Yeah, I think to me, leverage is one of the coolest parts about real estate. Mm-hmm. Because if you think of any other investing strategy, if you were to go to the bank and say, hey, I want to buy $50,000 worth of stocks, would you give me $40,000 to do that? And I'll put in 10.
I don't think so. What about crypto? Is the bank going to lend you money to
Probably
invest
not.
In crypto? No.
I don't think so. And to me, this is really one of the coolest parts of real estate is that you can utilize leverage to get a property. So you're using another pot of money that's not yours to buy an asset where you're only putting in, can be anywhere from like 30% to, there's some that you can do 5% if you're going into CMHC. Mm-hmm. You have a ton of opportunity that way that you can get a hold of these incredible assets and only put down a portion that you need to actually buy it for.
Yet you receive all of the benefit of that asset going up in value with borrowing money and only having to put maybe 20% down.
Yeah, leverage is a really incredible part of real estate. And again, I think this is something that a lot of people don't understand how powerful it really is. I get a lot of people that come to me and say, okay, but then the bank owns the asset and not you. So how is that beneficial? And, wouldn't you want to pay off the bank? Wouldn't you want to get rid of the bank in this situation so that you own the asset entirely? And again, depends on your situation. But to me, I would never want to pay down that leverage because that's an opportunity that's being given to me to gain other assets. So if you have a property that you have 40% equity in, and you can go to the bank and say, hey, I'd like to access 20% of that. Can you give me the 20% and throw the loan on that? Now I have that money and I can go and buy another asset with it. So now I have two assets with the same recycled money because the bank is willing to give me money, is willing to leverage that property. And I can continue to recycle that money to get more assets. Yeah. And that to me is the incredible part about real estate. So I'm fine if the bank has a mortgage on my property. I get nervous when the leverage is maybe a bit too high.
Or over leveraged.
Mm-hmm. You want to be careful to make sure that you don't have too much debt on the property. You want it to still function. And you want to be careful because the market can still fluctuate. You want to make sure that the property isn't over leveraged. Mm-hmm. But take advantage of that. That is that to me is brilliant in real estate.
You mentioned never paying down your mortgage. So I just want to, because that can be very controversial. Mm-hmm. I want to clarify that we are talking about rental properties. We are not talking about your personal residence. If you want to pay down your personal residence to zero, that's great. You want to put those lines at the end of your driveway, because I'm pretty sure that's what that means, is that your mortgage is paid down. That's fine.
Isn't that what Scott McGilvery says?
I think so. That's fine. There's nothing wrong with that. If you can, especially if you can access the equity in a different way, to be able to invest. But we're talking about investment properties. We're not talking about your single family personal residence that you want to pay down the mortgage.
We're talking about properties that someone else is paying your mortgage.
Yeah.
Basically. Because then again, if it's coming out of your pocket, that's now could be considered a liability. So I think that's a good clarification to make. But definitely in the world of real estate, I think leverage is an extremely powerful tool that, and I know it's a bit weird as like a profit center, but it really is, because, you know, when
you're
you think
using
of
other
refinancing,
people's other pots of money in order to buy a bigger asset that you would have otherwise not been able to purchase.
Yeah. And being able to access the equity that you've created to pull that out and buy more assets.
Yeah. And a good example of leverage actually is taking, let's say you had $100,000. We'll just use very simple numbers and probably unrealistic for the market we're in. But you have $100,000, you could buy one $100,000 property cash, or you could buy, 5 properties using the bank's leverage at $20K a piece if you're doing 20% down, because they're gonna finance 80% of it.
Yeah. And I mean, I know I would rather have 5 assets than one, and your tenants are now going to pay down that mortgage and create the equity for you.
And as those go up in value with appreciation, which is our next topic, I guess, our next profit center that we're going to talk about, then you are benefiting from that appreciation, not the bank.
Yeah. So I guess on the topic of appreciation, there's 2 types of appreciation. Start with passive maybe, because it's, again, that's a pretty... That's an easy one that, again, I think this is one of the least predictable profit centers of all of them, because it changes year to year. Sometimes the market can go up. Sometimes the market's flat. Sometimes the market...
it goes up 20% during COVID. Other times it goes down because COVID inflated everything.
Yeah.
But yes, passive appreciation is the market dictating what your asset is worth, essentially. Yeah. Usually going up with inflation.
Yeah. And again, this is very different depending on your market. So in somewhere like Ottawa is I'd say a pretty overall stable market. Obviously we do see fluctuation here, but Ottawa tends to creep up at about the same average percent every year. And then you have other markets that, you know, I think something like a market in Alberta, depending on how oil's doing, you're going to have booms, you're going to have crashes, you're going to be up and down quite a bit.
Big boom and big bust.
Exactly. Yeah. So appreciation, this is the one that's a little bit less predictable. This is where it's good to know the market that you're investing in, because then you'll get a better idea of what the average appreciation is year over year. And you can get an idea of what your property might appreciate at that point. But it can be a little bit unpredictable.
Look at a 20-year average of housing prices, or of whatever similar property that you're looking at purchasing, and then you'll get a good idea of what the appreciation is year over year.
But this is really like a cherry on top, right? Like this is the
passive
one that
appreciation for sure.
Yeah, you're literally doing nothing for this. All you've done is purchase, I guess not nothing. You had to purchase the property. But once you've purchased it, you're just letting appreciation, inflation do its thing and increasing the value of your building. Yeah. The nice thing about real estate is, because it is a tangible asset, you do have that capital preservation. And this is where that capital preservation piece really comes into play, is because it is a tangible asset, it tends to appreciate with the market
and with inflation. Right? So now you are hedging your investment against inflation. Yeah,
exactly. So that's a huge benefit of real estate, because it is tangible. You can go, you can touch it, you can hug your real estate, you can lean on your real estate.
You can kiss your real estate.
Yeah, you can cuddle your real estate. It might not be very cuddly back. It might be a little uncomfortable, but that's okay. You can try. But that's the thing with tangible assets, is that they do hedge against inflation. And that's where some of the beauty of real estate comes in. It's not like you hear people that invest in the stock market, and it tends to be all over the place.
Volatile. It's very hard to predict.
Yeah, and I'm not saying, and we don't have anything against any of the other investing avenues. So we're not saying don't invest in stocks, don't invest in crypto, whatever. That's not where we're going with this. It's just this is the difference between investing in real estate and investing in some of the other avenues.
Yeah, so that's passive appreciation. There's also active appreciation. So this is doing something to the property.
This is doing this.
Rolling up your sleeves, getting your hands dirty, getting angry with it, maybe swinging a hammer. No, you went like this. I just thought you were angry.
Getting ready.
Oh, I see. That's the determination.
Okay, but sometimes renovations do make me angry, so
absolutely. That's not what this is about. This is about increasing the value of your property by doing some form of value add renovation or reducing expenses, that type of thing. So you're getting in there, you're making a change to the property for the better to increase the value of it, and you're essentially forcing the appreciation. So this can be called active appreciation or forced appreciation, increasing the rents in the property with it. You don't even have to do renovation. Sometimes you just turn over a unit and increase the rent on that unit, and now you've forced the appreciation of the property. Because the property is valued based off of the NOI, which I think we talked about in another one, or we can talk about in the future either way. Yeah. But income versus expenses.
Yeah, and I think that's a really good point, because when people hear, people call it forced, some people call it active, whatever you want to call this type of appreciation. But I think a lot of people really have in their head that you have to start swinging hammers and doing major renovations. And that's something that I think I didn't realize until I got into the multifamily space. So we're talking the commercial space. So your 6+ unit properties. I think that's a really good point, that it's not necessarily about going in there and doing a bunch of renovations. It can be decreasing in expense.
Yeah. Changing a toilet, changing a leaky toilet.
Yeah.
Putting low flow toilets or fixtures in that are going to reduce the water usage. Putting in high efficiency appliances, high efficiency heating systems that are going to reduce your expenses. That's going to make a major impact on how much expenses you pay, which is going to impact your net operating income, which is going to increase the value of your building.
And I mean, I'm not going to say that increasing rent and decreasing expenses is easy, but I mean, it's a little less sweaty, I think, than
renovations.
Getting doing some renovations.
Sometimes you have to do the renovations in order to increase the rents.
Yes.
But either way, that's ultimately active appreciation, another profit center.
Yeah.
What else?
So there's one more. I don't know if it would be the ability to negotiate or what that looks like. But really what it comes down to, and this is what a lot of people talk about in real estate, is making money on the buy. So whether you want to call this a profit center or whatever, this is another way for you to be able to make some money in real estate on the same project. And this comes back to learning to be a great negotiator. And this doesn't mean being a bully.
Brushing up your skills.
Yeah. You don't have to bully someone into, giving you a price that's under market value. I have a ton of people, and we have a project right now that they're brand new buildings. And do you want to tell them
what we negotiated?
What our under market value is?
$650,000 under market.
Yeah.
We actually negotiated over $1 million, or just under $1 million off of the asking price.
And again, this doesn't mean you go in and you bully your way to a price reduction. It comes from getting to know your seller and what they need and what you can do to help them. I have a ton of people that are like, why would someone sell you a building for under market value, especially one that's new? And I have people that literally don't believe that we have it under market value. They'll come to me and they'll be like, no, like I've had people say, I don't believe you. And I don't believe that someone would sell their property for under market value.
Well, we can show the APS and we can show the appraisal report.
Okay,
well,
so no, I know, but this is just like it's kind of pushing the point home that when you get to know, when you take the time to know the seller's situation and you don't just go in bullying them for the price that you need and poo-pooing on their building or whatever to try to get a price reduction. If you actually try to get to know their situation and try to understand what they need, be flexible, be understanding,
be likable,
be likable, and work with them, these are possibilities. You just have to actually take the time to get to know them, and just like Jasmine just said, solve a problem for the seller. That's
Absolutely.
exactly it.
Yeah. That's our strategy. And again, we're talking about negotiation strategies here, not necessarily just talking about being a good negotiator in order to bring us back on track to the profit center, which is equity on the buy, right? You want to be able to purchase the asset so that as soon on closing day, boom, you have equity. That's a profit center, right? Yeah. You've now purchased that under market value.
Yeah, and it's possible. Don't think like, oh, because it's at this price, like it's appraised at this, or it's a new building or whatever, that it's impossible to do that. It is possible. It takes a little bit of work, and it takes sometimes people,
6-7 months of work.
Sometimes something like that. Yeah,
absolutely.
It takes people skills.
But there's the asking price, and then I'll make it a bucket. There's the asking price, and then there's the purchase price. They're very different. They can be different.
Yeah, no, it's true.
It all boils down to understanding what they want, and just being a good negotiator, right? If you're able to negotiate a good deal on something and get equity on the buy, then that's a win.
Yeah,
that's a win right there.
Yeah.
There is something that we didn't talk about. Sorry, did you have something else you wanted to add to that?
Nope.
We didn't talk about tax advantages.
Mostly because we're not accountants and it makes me nervous.
Talk to your accountant. But there are a lot of tax advantages. So in new builds in a lot of new municipalities, they're actually giving you a break on the property taxes or land transfer taxes. Different municipalities have different kind of incentives, I guess, but there's a lot of incentives that come with real estate. And depreciation is one of those. It's a really big deal. Again, talk to your accountant if it makes sense. But essentially, you're deferring paying taxes on the income until you actually sell the property.
Yeah, but that's not the only depreciation and tax advantages for new builds. That's not the only tax advantage for buy and hold. And I think this is something, again, that a lot of people don't really think about, especially when they're going the private lend route. Is if you're doing a private lend, that's active income. So if you are a high income earner, you may not want to be adding more income, even if you're not a high income earner, if you just don't want to be paying more taxes on active income, that may not be the right strategy for you. It sounds great. You're making 10-15% return on your money, which, that can be great. But remember that that's taxable. Mm-hmm. So when you move over to the buy and hold space where you're going to have equity, so you have ownership in the property, now some of that income is no longer taxable. So part of it is, and it depends on how the deal is structured, but part of that income might be capital payback. So it's the money that you put into the deal, you're just getting that money back. So that's not taxable income. Obviously, once you have your money back, things like cash flow, that is active income. So you will be taxed on that. But the nice thing about real estate, when you're getting into the equity part, is that is only one of your profit centers. And again, it doesn't tend to be the majority of your return. Mm-hmm. So you have your taxable income with the cash flow, but the rest of it is equity. So if you were to access that equity, so if you were to do a refinance on that property and pull out that equity, which is a good chunk of your return, that's not a taxable event because you're basically just using debt, which is insane. So again, there's these different and again, talk to an accountant. I am not an accountant, and neither is Jeff.
But ultimately, refinances, you can't pay tax on borrowed funds. It's not income, right? You are borrowing that money from the bank. A refinance is borrowing money. You're paying that back through interest.
Again, going back to the leverage.
Yes.
Right? You're using leverage.
Adding leverage to the deal.
Yeah, you're putting more debt on the deal. So you're going back to the leverage piece. You're pulling out that money that's replacing it. And you're able to use that for depending, I know there's some programs that you need to use it for certain things in a certain amount of time, but you now have access to that equity, and that's a huge payout for you that isn't taxable.
Yep.
So again, a lot of tax advantages. Definitely for someone who's a high income earner, this can be a huge advantage because you're not getting this like consistent addition to your regular income.
Marco, yes, talk to your accountant.
I will say that over and over and over again because I am not an accountant.
We are speaking from our experience.
Yes.
Oh, I took accounting in, fun fact for you guys, I took accounting in college 3 times.
And he doesn't know if he ever passed
I'm sure
it.
I did. I must have. I think I needed it in order to graduate, and I graduated. So there's a diploma somewhere around here.
That one.
No, but
yeah. So we are definitely not accountants.
It was accounting 101. I failed it at least twice.
Jeff could hardly pass accounting, so talk to your accountant.
Yet who does our bookkeeping right now?
He does.
I'm good at it now.
Slightly concerned. No, you are good at it.
My accountant taught me well.
Yeah. No, but there are a ton of advantages when you're getting into the equity ownership side. And again, the equity side is where you start to be able to tap in to all of these profit centers. So that's where these advantages come from. And again, not poo-pooing on private lending. There's
a time and
place for all of it. But just understanding the differences between them and what the pros and cons are to both sides.
Yeah.
So, yeah. So those were really the profit centers that we wanted to talk about today. I think the biggest thing to remember with buy and hold real estate, and I know we've probably said this and I might be going around in circles, but the coolest thing about buy and hold is that you have these profit centers. And I think a lot of people focus so heavily on cash flow because they're used to seeing things like if they're investing in stocks, if they're investing in RSPs.
What's my cash on cash return?
Yes, because that is the only return that they're getting.
Yeah.
And when you get into the real estate world, the cash flow isn't the be all end all because you have all of these other profit centers. Yes, that's going to be more likely equity, so you're not going to see it in your pocket. But again, you can use leverage to access that equity. You can pull out really everything you put into that asset initially. So you put $100K into that asset to buy it. You can use leverage once you've created equity to pull out that $100K. Now you have no money left in that property. You've removed it and you can move on and buy another property and still own that first one. Yeah.
That's an infinite return right there, my friends.
And that is where real estate is so powerful. That is where creating this equity, having that little bit of cash flow that's, going to keep your pockets happy every month, but being able to remove your initially invested capital, move it into another project, and just recycle it through all these properties, that's where you're going to build wealth. So I made a post about this recently. I still get comments on it. It was like a week ago, but this is where the power of real estate comes in. So I urge you to, especially if you're investing for equity, to look past just the cash flow and keep in mind how powerful it can be to create equity in a property and to be able to remove that equity and to be able to recycle it and to build your portfolio that way. So that
was a rant.
That's it. That's all I have to say about that.
Well done. I like it. If you guys are interested in hearing about or talking more about these profit centers, definitely reach out to us. If you want to hear about how we did get that 600 and plus whatever, over 600K of equity on the buy for our 24 unit deal, reach out to us. If you have any comments about today's what is this, a podcast? This is like a live session. Yeah. I don't know what this is.
It's not a podcast, I don't think.
It's similar. If you want to be a guest on it and turn it into more of a podcast, there is a way to do that. We can bring you in if you want to talk about something specific, or if you want to hear us talk about anything else, then definitely reach out, let us know. Drop a comment, share it with your friends, and I think that's it.
Yeah, and we'll be back next week, same time, same place, 12:30 Eastern.
Live webinar. There we go.
On
Thanks,
Tuesdays. Live webinar. That's what we're calling this. Yeah. Otherwise, have a great rest of your day, and until next time.
Love you all. Bye.